Meantime, the rally was not on autopilot today. Stocks pulling back as investors await Fed Chair Powell's speech tomorrow at the Jackson Hole Conference. Joining us now is BofA Securities head of U.S. equity and quantitative strategy, Savita Subramanian. Savita, so great to catch up with you. I mean, I guess if I just look at a chart of this year in the S&P 500, it says, wow, it's a strong uptrend. We had a normal seeming correction, a partial comeback from that correction. Maybe we got a fourth quarter rally, but there's plenty going on below the surface. And I know you've been very focused on what's been winning and what ought to start to win and what should be rewarded in this market. So how should we be playing it right now in terms of looking for fresh opportunities?
Yeah, it's a great question. And I think this is a market environment that is a little bit trickier than, even where we were at the beginning of the year, because sentiment is no longer as bearish on equities. You've got a lot of buyers of stocks that have done well this year. So, it's kind of the idea that we've averted the disastrous hard landing. But, on the flip side, it's hard to say sentiment is super bullish when you look at valuations of the average company in the S&P 500. And, the equal weighted S&P is trading at almost a record discount to the cap weighted S&P. So there's a lot of different things going on, as you mentioned. I think what's interesting right now is if you look at just the trends that we've seen since maybe mid-year, we've seen a broadening of the market, and I think that is likely to continue. We're in an environment where the two sectors with the strongest earnings revisions are financials and technology. So two sectors that are very different. One is growth, one is value. One is all about kind of the future, long-term growth, and the other one is more about just kind of credit and financing and a healthy economy. So I really think we're in an environment where it's going to be harder to outperform the benchmark by just owning mega cap tech. And that was kind of the call for most of this year. I thought the market would broaden out earlier. And I think where we are now is an environment where we're starting to see that happen. The S&P equal weighted index hit an all-time high. I think it was last couple of weeks ago. Mm-hmm. So we're seeing those trends start to play through, and I would stick with that. I still think it's too early to buy the Russell 2000. So when I think about mega cap tech and I think about small caps, both of those tails of the distribution look a little bit maybe not as fruitful as, kind of cyclicals, industrials, companies that are kind of GDP sensitive and might not fare as poorly as folks were expecting at the beginning of the year, given the hard landing scenarios that were painted. Yeah,
I mean, obviously a very good distinction between sort of the average or median large cap stock relative to the small caps. Your point about a record discount of the equal weighted S&P versus the cap weighted S&P driven by the mega caps. Is that just not another way of saying, boy, those mega caps are really big and expensive? In other words, on an absolute basis, are they cheap?
That's probably an easier way to say it. Yeah, that's absolutely right. I mean, mega cap tech is pretty expensive, but then the average company in the S&P that's not mega cap tech is actually pretty fairly valued. So, it's kind of a good environment to buy the average company in the S&P 500, because think about it. Earnings are moving higher. We just heard a few companies report. Most companies are beating on bottom line and at least meeting on top line. The Fed is probably more likely to cut than raise rates. I mean, who knows when and who knows how much, but the direction is bullish for risk assets. So we're in, a pretty healthy spot for your average equity. I just worry about the equities that are maybe, too expensive and too crowded, i.e. tech and AI and all of these themes that have been running hot for, multiple years. But I think it's a good time to buy, the average company looks pretty healthy. And this doesn't seem like a setup where you really want to sell stocks. I do worry about this big binary event coming up in November, the election. So I think that's we're heading into a seasonally weak month, but it could be a seasonally weak couple of months into November if we stay in this sort of very close race and there are some pretty big swing factors that could be outcomes on either side of the aisle. So those are other factors I would watch. Listen, if I were going to stick with one theme right now for, let's say, the next couple of months, I would be buying large cap value, dividend yield, quality. I still think we're going to be in a volatile market environment for the next few months, maybe for the next few years. And your returns aren't necessarily going to come as greatly from price appreciation as they are from total return. So I think we're moving back to a good old fashioned total return type of market. And in that market, you want to look for income.
All right, and just quickly, you retain a 5,400 S&P target. I guess that's sort of based on the idea that the huge cap stocks maybe haven't have given you what they're going to give you.
Yeah, exactly. I mean, point in times estimates are fraught with peril, but yeah, the idea is by the broader index, not the biggies.